Well, South Africa's economic performance in the first quarter has been lauded as a good start to the year, but more risks still remain when it comes to our economic growth targets. One of the most important sectors in our economy is the manufacturing and, of course, the construction sectors, which employ a number of people in South Africa. Joining me now to make sense of what the latest GDP data means for those sectors is Tafadzwa Chibanguza, Chief Operations Officer of the Steel and Engineering Industries of Southern Africa. Tafadzwa, thank you very much for joining us. Something that I wanted us to speak to off the get-go is the jobless growth we have seen in the past in South Africa in the early 2000s, where our economic growth was averaging between 4 and 5%. Still, unemployment was still high during that time. Are we still seeing jobless growth in South Africa, seeing that in the first quarter unemployment numbers were much better, correlating with these GDP numbers?
Kolani, thanks for having us. It's a privilege to be here. It's an age-old economics question, right? And it has an element of, and you're correct to say that this is a trend that we've seen for the longest time, early 2000s. And in fact, now more than ever, we see that. There was a report that came out last week from PwC actually that mentioned the fact that GDP is no longer necessarily the only necessary condition for employment creation. So in essence, what you're seeing is that the employment intensity, which is basically your employment creation per unit of GDP created, is actually weakening. In our sector that we represent, and we'll sort of define what steel and engineering is in terms of a sector, we've also seen that. I actually did a similar calculation about 5 years ago, looking at production and employment. And as much as we saw some increases in production in the first quarter of this year in our sector, employment numbers have continued to decrease. And we see a weakening of that correlation. So it's a number of factors, right? And that's where I started, where I said it is an age-old economics question that as your economy becomes more service-oriented, you need less people for more output. There's also issues of globalization, where you don't have to be the only manufacturing center well, you don't have to manufacture everything, which then would be the employment creation. So the point, though, I think the takeaway there, and this is the lesson from these calculations around the weakening of employment creation from GDP, is that what is actually needed is targeted employment incentives to incentivize the creation of employment. That is what would strengthen that relationship. But the point is that it's actually not, GDP growth is actually not a sufficient condition for employment creation.
Let's talk about your sector, a very important sector. I mean, prior to the 2010 World Cup, South Africa was this huge construction site. There was construction everywhere. But now you're seeing that when it comes to manufacturing and your steel sector, construction has not recovered in the first quarter. It's still 25% below pre-COVID-19 levels. Why is this?
Yeah. I'll start on the construction side that you mentioned. And I think, when the story of the country is told, I definitely think that is an area that a missed opportunity will be highlighted. And I'll make a point that, for example, if you take the mining sector, what drives commodity prices are global demand and supply factors that are not necessarily in the hands of a country. But to deploy a large-scale construction project, right, is actually squarely in the hands of the state, where, well, in the state and domestic, like the construction sector, its performance is actually determined by just spending more on construction, which is actually the point that we've often highlighted for us, that one of the things that will create a good anchor for our sector, steel and engineering, its growth, as a growth driver and a growth measure, is actually large-scale capital projects, which in the form of infrastructure, and we're just not seeing that. And that's actually a policy choice. That's the important thing, Kolani. It's a policy choice that, do you spend it on consumption or do you spend it on long-term growth drivers of the economy that with the conversation we've had now about targeted employment incentives, and then together that way you set the economy on a trajectory for growth, but sustainably, and that's the point.
You're talking about infrastructure.
Yeah.
We had that buzzword for 2 years now.
Yeah.
COVID-19 did disrupt many of the plans,
Yeah.
but the infrastructure projects that the government has targeted, 1 trillion rands. You are saying we have not seen any movement, despite some of the stimulus that we've seen, which led to better economic growth in the quarter 4 2021 and the first quarter of this year. You're saying there hasn't been any movement as far as SAFSA is concerned when it comes to that infrastructure rollout.
Absolutely. When you look at, first you just have to look at these numbers. Let me put it that way. This 0.7 decline in this quarter, the 25% pre-COVID level that you mentioned already. If it was rolling out, we would be seeing it in the numbers, but we are just not. From a SAFSA point of view, and maybe this is the perfect time just to define, so we as a sector, when we call steel and engineering, we represent 26% of the manufacturing sector. In there are steel mills or mini mills and your large-scale mills, so who produce actual steel. But then we also represent the entire value chain up to heavy engineering. So from a construction point of view, where we would see it immediately is that part of our members are civil engineering type firms, right? So that's a form of manufacturing. A form of construction, and we're not seeing there. But also a lot of our members supply product into large-scale construction projects. What has driven our performance of our sector in this particular round in terms of quarter 1, so I must also make the point that in this 26% of manufacturing, we did see a strong Q1, but much of that Q1 strength that we saw was really in what we would call demand from sustaining capital, so capital invested by either companies, mining companies, or the state in terms of just sustaining projects, but not expansion capital.
Yeah.
And that point is very important because that expansion capital is this long-term driver of economic growth, which would naturally trickle down to our sector. So that distinction, when we looked at these numbers, comparing it to the more high-frequency data that we look at from a production point of view in our sector, that distinction does come out very clearly, that it's more sustaining versus expansion capital. And in essence, what you want is the equation to be leaning more to the expansion capital side.
Tafadzwa, when you took this job at SAFSA, an important sector in South Africa, in March this year, when you took this job, the first thing you said was calling on government to actually implement some business-friendly policies. And you're not seeing that. And if you ask anybody in government, they'll tell you that they are working hard to make sure that South Africa is open for, investments, and the business is doing great. But we are not seeing that. What is it that government should be doing, according to SAFSA, to make the country more friendlier to even local investors so that our economy grows?
Yeah, absolutely. On that, there's 2 legs to that answer. The first one is the idea of there needs to be a targeted looking and working on the general cost of doing business. And that's an important area because right now, structurally, the country has a punitive cost of doing business. In there, you can talk of if you are going to export a product. We know the port, South Africa ranks one of the highest port charges if you're going to export. So already, even if a product came out of your factory cost competitive, by the time it hits the port, that equation starts to shift out. We know issues of electricity. We know issues of, there's considerations, which was a progressive move now to reduce the tax rate. That was progressive. But we think a lot of that can be done a lot faster in dealing with the cost base. Then the other side of it, which is very important, which again creates demand in the economy, but also fixing the economy, is greater private sector participation across the board. And in there, I'm saying in energy, bring private sector. We know there's a reform around the 100 megawatts, but we know those projects are tied up in administrative burden. Did it have to be 100? You know, why not make it bigger? In ports, we know there's the reform around private sector involvement and private sector concessioning. But also we know there was an issue with how the contracts were structured, 2 years when the equipment is actually for 30 years. And municipalities, right? If we consider the fact that in municipalities, the Treasury last week came out and said that 66%, 170 municipalities of the country's 257 municipalities are actually in one or other form of dysfunction. And we know that that inefficiency breeds costs, which again feeds back to my point. So there's a big part that private sector could play in municipal issues, fixing roads, water reticulation, and you fix the economy, you create demand in the economy to fix the economy, and ultimately also you resolve the cost of doing business and a better South Africa.
Tafadzwa Chibanguza at SAFSA, clearly calling for more private sector involvement to actually shore up our economic activity and make sure that we even help our municipalities reach those development targets. Thank you very much, Tafadzwa, for your time.